All right, so if you're looking to get smart and quickly on the companies that are really defining the next decade of retail, you've come to the right place. Today, we're cracking open the playbook of one of the fastest growing chains in America, Dutch Bros.
It really is a fascinating moment for them. I mean,
Yeah.
they've made this incredible leap from a quirky regional favorite out of Oregon to a real national growth story.
And now they're at this critical inflection point.
Exactly. And the big question, the one everyone is asking, is pretty much binary. Are they going to keep compounding, like a young Starbucks?
Hmm.
Or are they going to hit that operational wall, that cultural dilution that tripped up another fast-growing brand we all loved, like Shake Shack?
That's the ultimate dilemma, isn't it? And that's
Yeah.
really what we're going to dig into today. Our mission here is to analyze the growth trajectory of Dutch Bros, Rocos, on the ticker using the sources you sent over.
Right.
We're here to unpack those two very different playbooks because the difference between those outcomes is, it's billions of dollars.
Billions of dollars in years of steady growth versus a really frustrating stall. This isn't just about selling coffee. It's about scaling a very unique, culture-driven service model across thousands of locations. They have to prove that their specific flavor of drive-thru can work everywhere.
Okay, so let's start with the gold standard here, Starbucks. When we talk about the Starbucks playbook, we're talking about an empire built on scale and, most importantly, consistency. It was all centered around what Howard Schultz famously called the third place.
That warm social cafe, somewhere between home and work.
Exactly. Starbucks didn't just sell you a coffee. They sold you a predictable, welcoming place where you could hang out for 2 hours.
And this is where Dutch Bros just completely flips the script.
Yeah.
They basically looked at the third place and said, what if the best place is actually just the driver's side window of your car? I mean, almost all of their 1,000-plus shops are drive-thru only. Their priority isn't a big, comfy interior. It's extreme convenience, speed, and this genuine high-energy connection with their employees, the Broistas.
Okay, but my immediate question then is, aren't they sacrificing the very thing that built Starbucks' loyalty? That reliability, that physical space. Is a cheerful Broista really enough to replace the comfort of a cafe?
Well, that's the tension, but they've engineered their model to work around that exact sacrifice. The sources show that a typical Dutch Bros shop costs about, $1.7 million to build?
Which has to be cheaper than a full Starbucks cafe.
Oh, significantly cheaper, especially in a dense urban or suburban area. And that financial nimbleness is absolutely key to their strategy.
Oh, it's all about the return on capital.
100%. The critical metric here is that they can pay back that initial $1.7 million investment within just 2 years.
That's incredibly fast.
It's lightning fast.
Yeah.
So while their average sales per store might be a bit lower than a big cafe where people linger, the speed of that payback lets them expand so much more aggressively. They can just keep rolling into new suburban areas where the drive-thru is king.
And we also have to talk about the product itself, because we're not really talking about the traditional coffee market here, are we?
Not at all. And that explains their hold on younger customers. Dutch Bros is really a fast casual lifestyle brand. A huge 80% of their sales come from cold drinks and energy drinks, not hot coffee.
Right, so we're talking about their Rebel energy drinks, all those customized sweet beverages.
Exactly. That whole product mix is aimed squarely at a younger, high-energy consumer, the exact demographic. Starbucks is now fighting really hard to win back. Boros just went straight for them with a high-energy product and a high-energy experience.
So that model, it gives them a huge runway, which, okay, brings us to the bullish case. The argument that Dutch Bros could actually follow that Starbucks blueprint and become a real compounding machine.
Oh, the runway is
Oh,
it's massive. You look at the numbers, they have just over 1,000 stores today. Their long-term target is 7,000 nationwide.
7,000. For perspective, Starbucks has over 16,000 stores just in the U.S.
Precisely. So that 7,000 goal, it suggests they see themselves as the essential number 2, the main alternative to the big guy.
And that goal doesn't seem so crazy when you look at a map of where their stores actually are.
It's not. Their footprint is still so heavily concentrated in the western U.S., Oregon, California, Arizona. When you look east, it's just a huge blank map. That geographic white space is their growth engine for the next decade.
But expansion is only good if the economics underneath are solid. So what do the sources say about how efficiently they're scaling?
Well, they're showing the proof of concept is there. The growth isn't just from opening new doors. Same-store sales are growing in the mid-single digits this year, which continues a really strong trend.
And that's the critical part. It means the old stores are getting busier at the same time the new ones are opening?
Yes, that is the perfect blueprint. You're expanding the footprint while improving the economics of your established base.
It's the classic compounding machine.
It is. And they're shop-level margins. So the profit just from the store itself are very strong, getting close to 30%. They've also been consistently profitable at the corporate level since 2024. This is exactly what Starbucks did decades ago.
So beyond just opening more drive-thrus, there's always the opportunity to monetize that brand in other ways, right? That's where the real acceleration can happen.
Yeah, and that's the upside optionality.
Yeah.
And honestly, it's a little thin in the current conversation, but it has to be part of the bull case. They have to extend the brand into, consumer packaged goods, CPG.
So like ready-to-drink cans on grocery store shelves?
Exactly. Think canned Rebel energy drinks or other retail beverages. Because the margins on CPG products, once you get the supply chain sorted out, are often way higher and less labor-intensive than making a drink by hand at a window.
And you're not spending another $1.7 million to get that revenue stream.
You're not.
Yeah.
You're leveraging the brand equity you already built. That's how you go from a successful chain to a true national powerhouse.
Okay, that bull case is really compelling, but we have to flip the coin. This is where the Shake Shack comparison comes in, because rapid growth is full of risks. Shake Shack also came to market as this beloved darling, but as they grew, cracks started to show. Consistency returns. They stalled.
Right, and the central lesson from Shake Shack, and the biggest risk for Dutch Bros, is that your greatest strength is often the hardest thing to preserve when you scale.
And for Dutch Bros, that strength is the culture. It's that upbeat, personal interaction with the barista.
That's the whole moat.
Yeah.
And it's one thing to manage that when you have 50 stores in Oregon.
Easy. You can probably meet every manager.
Exactly. But try doing that with 2,000 stores spread across 20 states. You're hiring from totally new labor pools, far from your cultural core, even tiny inconsistencies. The new person isn't quite as cheerful, the drink tastes a little different. They start to chip away at that loyalty.
That's the cultural replication problem that Shake Shack ran into.
It is. Now let's talk about the money side of this risk. Because even with those great 30% shop-level returns, the overall financial picture is pretty sensitive.
How so?
The model is capital-intensive. They're spending a lot to open hundreds of stores. So despite that strong shop-level margin, their net margins, what's left after all the corporate costs, are pretty lean. They're sitting around 9%.
Wait, so from 30% at the shop down to 9% net, that's a huge gap. Where's all that money going?
It's being eaten up by the machine that runs the growth. It's corporate overhead, G&A. It's depreciation on all those new buildings. And it's often interest payments on the debt they use to finance the expansion. You have to build this huge corporate infrastructure before the new stores are fully profitable.
Which means with a 9% net margin, they have basically zero room for error on costs.
None. The sources point out that just a 10% increase in labor costs or a spike in ingredient prices could wipe out a huge chunk of that net margin. And when they move east, their costs will go up in the short term. They won't have their established supply chains or brand recognition.
And then there's the demand risk, which goes back to that 80% focus on cold and energy drinks.
Right. It's the cyclical demand risk. For a lot of people, a daily hot coffee is a habit, and it's almost a defensive purchase you don't give up in a recession.
But a $5 specialty energy drink?
That's a discretionary treat. It's much easier for a budget-conscious consumer to skip. If the economy tightens, their revenue could be much more cyclical than Starbucks' core habitual business.
So when you put it all together, Dutch Bros is kind of sitting right between these two stories. It has the brand power and the geographic runway of an early Starbucks, but it's facing the operational fragility of a company like Shake Shack that maybe grew too fast.
Yeah, that's the synthesis. The entire next chapter for them depends on one thing. Can they translate that vibrant cultural energy into durable, standardized operating systems? Can they turn a beloved vibe into a machine that generates consistent cash flow?
Okay, so for anyone listening who wants to track this themselves, what are the key vitals? If you could only watch 3 metrics to see which path they're on, what would they be?
All right, there are 3 things that tell almost the whole story. First, you have to watch same-store sales growth.
The pulse check.
It's the ultimate pulse check. It tells you about the health of the culture and the underlying demand. If that number dips below the mid-single digits, it's a red flag that either service is slipping or competition is creeping in.
Okay, that's number 1. What's number 2?
Number 2 is shop-level margins. They have to stay up near that 30% mark. That's the proof that the unit economics are durable. If that starts to slide, the whole expansion plan gets really risky, especially with those tight net margins.
And the final one, the true test.
Sustainable profits. The bottom line, we need to see that 9% net margin expand over time, not shrink. That's the difference between just getting bigger and actually creating value.
Yeah.
It proves they're scaling responsibly, not just frantically.
So they have this really rare opportunity. They can learn from the Starbucks playbook on consistency, but they also have the hindsight of what went wrong for brands like Shake Shack. Their story is definitely still being written. It demands, I think, both patience and a whole lot of scrutiny.
I agree. Look, the authentic edge of Dutch Bros is that barista experience. That's not debatable. It's real. But for the next chapter to really look like Starbucks, the critical question for me isn't just about geography. It's whether they can translate that cultural energy into those other revenue streams like retail products without diluting the core experience that got them here.
So if the brand becomes too common on a store shelf, does it lose the cult status that makes people line up at the drive-thru window?
That's the challenge, maintaining the cult while building the corporate machine. A fascinating dilemma, and one we'll definitely be watching.